We'll get started. I would like to do some basic introductions. I'm Katie Coppinger, for those of you who don't know me. I'm Executive Director of Development here at Mercy. And this is our first planned giving seminar that we're working with together, of course, with our Alumni Relations Department, which is, of course, stellar, and the entire team here. So we've got a lot of Mercy members here, which is great. We've got a nice audience of some Mercy staff, some of our donors. And so generally, I hope people who are interested in this topic. For many, it's a difficult topic. And so we're happy to be here and present some really terrific guests, professionals in this field, panels to share some basic information to help you all start these conversations when you're ready. I'm gonna introduce really quickly. We've got Chris Templeman. He's a wonderful guy, somebody I've known for many years. He's with Morgan Stanley Wealth Management. He previously, of course, was involved in the nonprofit sector as executive director of the Boys and Girls Club of Rochelle, and then went to the dark side of Morgan Stanley, but that's okay. We still like Chris, and he's a great source of information for us. We've got Elliot Sweetser also on our panel. He's a retired financial planner, and he's also come into our Mercy family. He's a donor to Mercy and connected to us by his wife, Esty, who is also part of our faculty. And so we welcome him to the Mercy family recently and found out that he has an expertise that we would like, of course, to utilize here. We've got Leslie Levine with us. Sorry, Leslie, if I missed
That's all right.
And Leslie is with Cuddy and Feder, and she's an attorney with a specialty in wills and estates and senior planning. Has, of course, a stellar resume and has graciously offered her time helping us here with this topic. And then, of course, finally, we have Tara Foley, who is an visiting assistant professor of accounting and taxation here at Mercy College, and a CPA. And of course, they have all volunteered their time and expertise to help us sort of deal with a tough topic, but hopefully they'll be able to break it down for us and give us some of that important information. So with that, I'd like to pass this on to our wonderful executive director of media, our Edie Magnus, who is going to talk us through and keep us on task. So Edie, let me pass this on to you. And thank you, Edie, for your help in helping us have a little learning session here. So,
my pleasure, Katie. Thank you. I think our major gift officers very wisely asked me to be your resident questioner for this program because I am, let's go with, uncomfortably ignorant in this area of planned giving. So I'm going to learn as much as everyone else will as we go through this. I want to do a little bit of housekeeping. This is being recorded. So if you want to hear it back, we will put it up for you to be able to access it. All of you who are in the audience right now are on mute. That's the way these things work. So if you have questions, I know we've gotten a few questions in advance, but if you have questions, you can go into the chat room and write them down, and we'll be monitoring the chat room to look for questions that we can answer either during the program as people speak or at the end of everybody's presentations. And finally, our disclaimer: this is not a professional tax or legal advice. We want to make sure that you know that and that you consult a qualified tax advisor or attorney about your specific needs. So with that, I want to start with two very big general questions. I think that that Elliot is going to have an answer for this, which is why people, they just don't do this. They don't plan gifts for later in life, and I wonder why that is.
Oh, shall I pick it up from here?
Sure, take it away.
Okay. Well, it seems like most of the material we're going to be covering today addresses the nuts and bolts of tax savings and so on. I'm focusing a little bit more on motivation. So I want to start by asking people what's important about the long-term viability of charitable organizations they're affiliated with, and what kind of a mark do they want to leave when they're gone. If people don't care, that's fine. There's nothing wrong with that. On the other hand, if people feel really strongly about contributing to something that's really part of the fabric of their existence, or an organization that they may have been affiliated with that they've benefited from, that's something that we would like to ask people to consider doing. Let me share a little insight, compliments of my 9-year-old grandson. A couple of years ago, he came home from school proudly telling all of us around the table about the math award he had just received that day. And we were all very impressed. Later that evening, he asked me, "Grandpa, how old are you?" I told him at the time I was 70. So he thought about that for a bit and came back and said, "Did you know you only have about 15% left?" So that really woke me up. I think people have a tendency to put things off that are not comfortable.
Elliot, do you think COVID has made a difference in people's thinking on this topic?
Yeah, for a lot of folks, they never think they're going to pass away or even get sick. And I think this has pointed out how clearly how vulnerable we all are to the unexpected.
Right.
All right. Thank you so much. We're going to get into now several specific areas about this, beginning with the benefits of planned giving. And Leslie, you're going to start us off, right?
Yes, I am. Yep. So thank you everyone for coming today. And I think to touch on what Elliot just mentioned is that I think people are afraid that as soon as they do their will, that they're going to die. And I assure you that it's not the case. And they also think it's very complicated to revise their plan to include charities. And it really is quite simple. So when you name the charity as the beneficiary, you can do it in several different ways. One is in your will or in a trust agreement, and that you need to go to an attorney for. And then in addition to any other changes you might want to make, you can include a bequest to your charity. So I leave $1 million to Mercy. And I also want to point out that a lot of people think it has to be big dollars. So that $1 million bequest to Mercy. But the reality is it can be anything. So it can be $18 to Mercy, just as a way of saying it was important to give to them during my lifetime. And I want to set this example for my family, the importance of philanthropy. So I'm including a bequest in my will. And it doesn't have to have a lot of zeros on the end. Of course, the charities love it when there's lots of zeros, but they're also very happy when they get it without the lots of zeros too. Excuse me. I'm not used to public speaking with the pandemic going on. The other way to do it is with a beneficiary designation form on an IRA, a retirement account, a 401k, an annuity. And there, you don't need to go to the attorney for that. You can just fill it right out on the beneficiary designation. One of the benefits to doing it that way is, one, it's simpler, you can do it yourself. But also when you think about retirement accounts, is the heavy income tax hit on that. And Tara, I know, is going to talk a little bit more about that. But one thing I like to point out to my clients is that if you're thinking about leaving $100 to Mercy, for example, that if I do it in the will, then Mercy gets $100. If I want to give $100 to my kid also, my kid would get $100. But if I do it through the beneficiary designation on a retirement account, when my child inherits that portion of the retirement account, they're going to get hit with income tax. And especially now with the changes under the Secure Act, they're going to have to take out the money much quicker, and there's going to be a bigger income tax much faster. When I leave that same amount to a charity on a retirement account, they get 100% of that money. So if I leave the retirement account to the charity and then I just leave my other assets to my child, then everybody gets really what I want them to get. So that's a nice benefit also. Wills are subject to probate. So if I leave the money to the charity in my will, then when the will is offered to the court and the executor is appointed, eventually the charity will receive the money. The Attorney General's office will also be notified. It's not a big deal, so it really sounds scary, but it's not. If I do it on a beneficiary designation form with a retirement account, then I don't have to wait for the court process. I don't have to notify the Attorney General's office. So it is, again, simpler. In all instances, whether I'm doing it through the will, through a trust, through a beneficiary designation, the estate will get a charitable deduction. So it is another way of saving taxes. So an important way to pass that legacy on and to show the children the importance of philanthropy, but also it's a nice way to save estate tax on your estate, whether you need it on the federal side or on the state side or possibly both. Can we go to the next slide? So some other options besides naming a bequest in your will or using that charity benefit designation form for the retirement account would be to create different kinds of charitable tools, such as doing an endowed gift with the charity. You can create your own foundation. So if you have a lot of philanthropic goals, that might be a way to go. There's donor advised funds, which I know that we're going to be talking about later with Chris. You can also do a charitable trust. There are different kinds of trusts that can be created. Again, you go to the attorney and talk to them about it. There are certain trusts that will give you some kind of income stream for your lifetime. And at the end, the money passes to Mercy, for example, or other ones where the charity gets the money up front and then people get it at the end. That's the charitable lead trust. There are pooled income funds, charitable gift annuities. You can make an annual gift. I write a check to the charity every year. You can make gifts of art. It doesn't have to be dollars and cents. And in all these instances, except for the annual gifts while you're alive, you're going to reduce estate tax in your estate to the extent you incorporate one of these plans in your alive, then your potential income tax saving. And I want to, if we could go to the next slide. So Mercy has a fabulous website that goes into detail on these plan giving options. So if you go on the website and it's on the bottom of your screen right now, and you click around, I encourage you to spend some time on the website and see all the different tools. They'll direct you, they'll give you more information. And I also note that if you do include Mercy in your estate plan, whether it's through that IRA beneficiary designation, a life insurance designation, in your will and a trust, then you can be a member of the Ronenberg Society. And so that will entitle you to special communications and information. So there's a lot of benefits to doing that. So I do encourage you to take the time to check it out. And now I'm going to pass the baton off to Tara.
Yeah, and Tara has just put, by the way, in the chat room, the link for everyone if you want to take a look at the gift plan page on the Mercy College website. You can see the URL there. Thanks, Tara. Go ahead. Is she muted? Somebody make sure that Tara can speak. Okay, good.
Hello, thank you very much. And thanks everybody for joining us today. I really appreciate it. It's been actually a lot of fun getting together with all of the people that are on the panel to put this together for you and come together as a team ourselves. I didn't know anybody on the team, so it was really nice to get to know everybody. So thanks for everybody joining this so that we can actually get together and put this together for you. So I'm just going to touch real quickly on some tax implications that you can push forward to 2021 based on what you can do for deductions. But I'm going to just talk about it at a high level because later in the presentation, when I talk about the CARES Act, I'm going to go through it in more detail. So many of you, when you do your taxes, I don't know how many of you actually send your taxes to your tax accountant and you don't even understand the taxes whatsoever. So I'll talk about the two different types of deductions that you can take. So there's the itemized deduction, which means someone who has, maybe property and real estate taxes, or you've got mortgage interest, etc. You pay state taxes. It makes your amount of your allowable deduction higher than the standard deduction. And so in the past, you can, in that itemized deduction calculation, you would put into their charitable contributions. So what's really great right now, and people should be taking advantage of, is two things. One, because of this CARES Act, it's being extended through December 2021, that previously your charitable contributions would have been limited to 60% of your adjusted gross income. But now this new rule is letting you have it up to 100% of your adjusted gross income. And I'll go into more detail about how you calculate that later on, which is really, really great. And also, many of you might have corporations that flow up to your personal tax return that you also will be allowed to have a charitable contribution deduction that wasn't there before. In the past, if you had an itemized deduction, that would be great. You can deduct your contributions. But if you were a standard deduction person, meaning you didn't have a lot of deductions that were allowable per the IRS, and so you just took the standard deduction that was allowed if you were single or married or whatever. This year, because of this help with the CARES Act through 2021, if you are a standard deduction person, you can do a charitable contribution of $300 and also deduct that on your tax return, which is really, really nice. The RMD, so many of you that have reached a certain age, 72 and a half, you have a required minimum distribution that you're supposed to take out. So what the good thing here is that you can do is you can actually have your charitable giving come out of your IRA, which would satisfy your required minimum distribution. And you get not only, because a lot of people don't like to take the required minimum distribution. In 2020, it was suspended. You didn't have to take it. You could keep it there because of what was going on. But now they've done a little bit better by saying, okay, if you have to take your required minimum distribution and in 2021, but you don't really need to for expenses, et cetera, you can actually take the money out as a contribution straight to an organization. So that would be meeting your requirement as for the minimum distribution. And also you get a tax deduction if you meet the thresholds for that charitable contribution that you made. So again, I'll talk more in detail about it and the gift tax and how much you can give for the gift tax, under the gift tax in the later at the end of the presentation.
Okay, I'm gonna ask a question, by the way. Let's go back. Leslie, I want to go back to you for a minute. All those tools that you mentioned, all those different ways to give, how do you evaluate what tool is right for you?
I think it's important to touch base with your attorney on it because you want to make sure you're doing it from the right spot. So in that example I gave, where if you gave the $100 to your child in your will versus on your beneficiary designation form, it's not really $100 when you give it to them through the IRA. So if you talk to your attorney, then you can look at the whole picture instead of just this laser focused picture on this one issue, because there may be other issues, and using trust might be a way to benefit not only the charity, but also family members too. So that's another important consideration, is what is driving the desire to do it. Is it just to give money to charity, or are there also other family interests there as well? For people who are reluctant to pick up the phone and call their attorney or shoot that email over because they're afraid the meter is going to start running and they don't want to drive up costs, then it certainly, you can go rogue and do it on your own, but it's always better to sort of look at it with your professional. So you can also talk to your financial planner, your, to see what might make sense from a cash flow perspective. And your accountant as well might be a good person to loop in. I think the team approach to anything is always great.
Okay. And Tara, I know you're going to come back to this, but I saw, push something to 2021. If you haven't done anything yet for 2020, did you miss a boat somehow?
Yeah, so in 2020, because of the CARES Act, if you made a charitable contribution, it would have been, prior to 2020, it would have been limited to 60% of your adjusted gross income. And now in 2020, that they're now extending to 2021, that if you make a charitable contribution, it's now limited, it's 100% of your adjusted gross income. So whatever your adjusted gross income is, you can do contributions up to that amount. And there's other layers of tax thresholds that you have to be aware of, but they have been dismissed right now. So there was, prior to that with the 60%, There's also, if you are over 20%, there's a whole calculation that people don't want to hear, but they're gone right now. So, and after 2021, I don't know if they'll stay, right? So if you make the contribution this year, you can make more of a charitable contribution and get more of a deduction this year than you would have had in the past.
Okay, that's what I wanted to get at. You can actually give more and get more of a deduction for it.
Now, it's the same thing I'm going to talk about later on. Yeah.
Okay. All
You know,
right.
and I want to just throw in one other thing that when certain life cycle events happen, it's also a good time to examine philanthropic giving. And so we are seeing during the pandemic that a lot of people are taking early retirement. They're getting out of the workforce and maybe selling their businesses. So if you're possibly selling your business this year, then it might be a good time to look at an offset for that potential capital gain that you might have on the sale of your business, and to look at maybe there are charitable vehicles that you can do to not have such a big income tax hit, capital gain tax hit when you do it. So that's why that team approach and not doing anything in a vacuum. So making sure everybody knows what you're up to. And that way you can see what makes the most sense to do and you don't miss any opportunities.
Okay.
Yeah,
excellent.
just to follow up on that, when I'm 49 and I did my will 5 years ago, and you know, I just felt this relief from having it done. And then when I had my will done, I then talked to, you know, the different people in my life and the different advisors in my life. And even though my lawyer was putting it together one way, once I kind of got more information from my family members and from my other advisors, we changed the will a little bit more differently to what Leslie's talking about. And then, and then in my everyday of how I said, oh, I'll just do my beneficiary form. I said, okay, I need to change the way I'm doing and thinking about things because of, like Leslie's saying, you're losing it out with taxes. So
there's a question in the chat room. Either one of you can pick up on this. If you already have a will, is it simple and relatively inexpensive to make a change in that will and, leave something to mercy, for instance?
So yes, the benefit is that now everything's on computer. So like in the old days, we used to do everything with carbon paper and retyping everything. Now you want to just add in a paragraph, a sentence in your will to add, I leave X dollars to mercy. The attorney should be able to make an easy change. Where the cost might add up is that, again, in that looking at the decision that's making you want to make this change is, does it impact anything else you want to do? So it may be time for a well-baby checkup of your estate plan to see, in addition to that one sentence you want to add about mercy, is anything else needed? So that could make it more expensive to do, but it's certainly worthwhile because then you're making changes that are beneficial. If it turns out, no, it's just adding that one sentence, it shouldn't be a heavy lift. It shouldn't be super expensive. You don't want to do it as a codicil. You do want to do it as a new will. But again, everything's on computer these days, so it's a real easy thing to do.
And sometimes state laws change, and it's good to have people look at those things anyway, right?
Yeah, I encourage clients to give everything a well-baby checkup at least once a year, usually around tax time. Since you have all your assets in front of you and you're thinking about your finances, it's a good time to dust those off, make sure you don't want to make any changes, and ask those questions of your attorney, of your accountant, and of your financial advisor as to, this happened in my life, this is what's going on with my assets or my family. Do I need to make any changes? My philosophies may have changed too.
Is there a difference between inheriting an IRA account and a Roth IRA account? There's another question from our chat room.
So when you inherit an IRA, when you have an IRA, you're designating beneficiary. So whether you have an IRA, whether you have a Roth IRA, any kind of IRA, there's all different kinds out there, 401ks, anything like that, there's always going to be a beneficiary designation form that goes with it. Yeah, it's important to make sure it's filled out properly. When the person inherits it, they're going to have an income tax hit on non-Roth IRAs. So there is that additional factor to keep in mind. But again, if you're using a charity as the beneficiary, it doesn't matter whether the charity is getting the Roth IRA money or the regular IRA money.
Okay, so it doesn't matter then. There's the tax hit only for individuals,
For
not
individuals.
charities.
Right. And that's the benefit to using the retirement accounts for the charitable planning.
Okay. All right. Okay. I'm gonna move us
And
along.
I just want to add one more thing to what Leslie was saying about gifts when you gift them. And to like Leslie's point, well, maybe you can't give $1 million and maybe you can give $10,000, right? So for gift giving, there's a tax if you give more than a certain amount. So for 2021, you can give up to $15,000 without paying a gift tax. So if let's say you're a couple and each of you separately gave $15,000 to a charity, then you don't have to pay a gift tax for that as well. So up to $15,000 for 2021.
Well, let me just clarify that when it goes to a charity, it's unlimited on the gift tax side. It's only to the individuals where you're going to run into having to worry about annual exclusions. So it's important to note that, it's unlimited, whether you give $1 or $1 million, something in between, or even more, that you can give any amount and not have to file a gift tax return if it's going to a charity. If you are using one of those charitable trusts or other vehicles, then you are going to need to file a gift tax return. And then there are other issues that need to be looked at as to what you're doing. It doesn't mean there's tax due, but a return is going to need to be filed.
Exactly. And that's the benefit, to give it to a charity versus an individual. That's what I was
Right.
Exactly.
Okay. All right. I want to move us to our next topic, which is tax-wise gifts. And Chris Templeman, you're going to pick it up from here. Thank you.
All right. Well, thank you, Edith, and thank you, everyone, for tuning in to this call. And as Katie mentioned in the beginning of the call, my name is Chris Templeman, and I'm a financial advisor at Morgan Stanley. And I currently work with over 100 charities and 100 charitable individuals. So really what I wanted to cover is sort of what I'm seeing out there in the charitable marketplace, and maybe share some ideas that I think would be helpful for all of you. And I think a good place to start is really sort of understanding where we are currently in the cycle. So the way that I really like to look at the market is really look at long-term cycles and try to figure out where we are in terms of that. So if you go back to 1940, if you looked at 1940 to 1960, that was a bull market in equities led by post-World War II. If you go from 1960 to 1980, that was a flat market. If everyone sort of remembers the 1970s, they were kind of a lot of things going on there. And then 1980 to 2000 was a bull market again. And then from 2000 to 2011, we basically had a flat market. It was referred to many as the lost decade in equities. And basically what Morgan Stanley thinks is that we entered into a bull market, which we think could last for potentially 20 years. It started in 2011. We just finished the first phase of that last year, and we believe that we're entering into the next phase. And we think that the next several years are really going to be driven by two key dynamics. The first is demographics. So millennials are currently entering into their prime working years. That was sort of the same phenomenon that was happening in the early 1980s, that you had baby boomers entering into their prime working years. And that was a big tailwind for the 1980s and 1990s, was that big group of people. And the other thing is all these things tied to the fourth industrial revolution, including the platform that we're on now with Zoom and robotics and electric vehicles and 5G, all these things coming very rapidly together is going to give that millennial working base a lot of really efficient tools to work with. So just looking back since 2011, so for the past 10 years, growth stocks have done very well. Even if you look at 2020, information technology stocks, IT stocks like Apple and Microsoft were up over 42%. Also, consumer discretionary stocks were up last year. And if you look at financials last year, they were down 3.3%. And there's been a rotation. So what we think is going to happen is that for the last 10 years, growth stocks have done very well. And that was really primarily driven by low interest rates. what we think are going to do well for the next 10 years are what are referred to as value stocks. So those are financials, industrials, materials. So what we're finding is that there's a lot of donors, like you perhaps, that have owned these growth companies. And there may be an opportunity to rebalance from that growth and to buy stuff like financials, industrials, and materials. And so instead of selling those growth stocks, one idea that you could do, and what I'm seeing a lot of, is that donors are gifting those growth stocks, which could be the Zooms of the world, the Teslas, the Apples, the Facebook, the Amazons, the Netflix, the Googles. They're basically carving off, not saying get rid of all of it, but just carving off some of the gains and gifting it, and then basically taking the cash that they would have bought those value stocks like the financials, industrials, materials, and basically just using that cash to buy those value stocks. And that's a little bit more of an efficient approach. Donor advised funds have surged. If anybody is not familiar with donor advised funds, they're basically charities that are set up. Morgan Stanley, for instance, has a donor advised fund. Fidelity, Schwab, Vanguard are very popular donor advised funds. And what they basically allow a donor to do is to gift money, sometimes with minimums as low as $5,000 into these donor advised funds. And then basically from that donor advised funds, they can gift to charities like Mercy College. And what's happened is that they've grown a lot. They've also, since maybe somebody might have gifted into that donor advised funds prior to COVID, if they were in a type of industry or a company that was really affected by COVID, the money is bucketed because it's already been gifted into this donor advised fund. So what I was seeing a lot of last year is that there was a big spike in people giving from donor advised funds because they had accumulated this money and we're looking at deploying it. And I just think if you are someone who owns if you have a donor advised fund, it's a really wonderful opportunity to gift to Mercy College because the assets in that donor advised fund probably have done very well. You probably have done very well since you opened it up. So just for consideration, gifting from a donor advised fund would make a lot of sense to make a gift to Mercy. In terms of retirement plan and life insurance assets, as was mentioned earlier, there's different life cycles where people maybe update their beneficiaries. COVID definitely has been one of those. I've just seen a lot of my individual clients basically just wanting to review their beneficiary designations just because with COVID, it was really something where you never really knew, it was just like, hey, am I going to be sick for a few days or am I going to be in the hospital? I better prepare, for that right now. So, the one thing I would really encourage you to do is really with retirement assets, as was mentioned earlier in the call, those are really great assets to leave to a charity because it's much more tax efficient in terms of doing that. It's more tax efficient to leave the non-retirement accounts to your individual beneficiaries, just because of the tax efficiency in terms of doing that. And so, just in closing, I would just, there's two things going on right now is that you might be getting ready to go get your taxes done. And sometimes you can really make good use of that time by saying, hey, I was on this call with Mercy College and there was a section that was talking about tax-wise gifts. I own all these stocks that have done very well. Do you think from a tax perspective, it would make any sense for me possibly to gift those to Mercy College, a place that I appreciate? And obviously you can talk with your financial advisor, wherever your accounts are held, just ask their opinion as well. And then also just to make sure that your beneficiaries are up to date. And the one thing I would just mention is that if you do include Mercy College, would really encourage you to let Mercy College know so that they can recognize your generous gift as a beneficiary, inside of one of your retirement plans. So with that, I'll turn it back over to you, Edith.
Okay, so a couple of questions here. Can we go back? Donor advised funds. Why would you do that as opposed to just give something to the charity that you want to give it to? What's the advantage?
Yeah, so the thing with donor advised funds, just speaking very frankly, is that they have grown a lot because charities other than Mercy College perhaps haven't done as good of a job at asking for money as Mercy College. So what a lot of donors have done is that they have said, yeah, I have to, either, my tax preparer said, hey, I have to make this gift to charity. Nobody really has made a compelling ask to me, so I'm just going to park it in this donor advised fund. And when something exciting comes up, I'll be able to gift it from there. I think it's a great opportunity to bypass a donor advised fund and just go direct to the charity. Obviously, if you're on this call, you care about Mercy College, so this can be a great opportunity just to check in with somebody from the development department to say, hey, I've been thinking about making a gift. My tax preparer told me I need to make a gift in 2021. Can you tell me a little bit about, some of the things that you have going on? Because I really want to make a generous gift. So donor advised funds are generally used when perhaps there hasn't been as compelling of an ask. And I'm sure Mercy College has made a lot of compelling asks. So I would just really encourage everyone in this call, to go to Mercy College instead of gifting to the donor advised fund, because it's just a more direct way of giving.
Yeah, so it's just donor advised funds, or if you're not sure, for instance.
That's part of it. If anybody else wants to chime in.
Yeah, I just want to tag on to that, is that one place where we're seeing a lot of use of donor advised funds now is with regard to, instead of creating foundations, or for clients who have had foundations but are tired of the administrative burden of running them. And so they're going to wind them down and then move that money over to a donor advised fund. So for people with a lot of money that needs to be given either right away. So as we were talking about before with, you're selling your business, you need a big offset, or you just are very philanthropic, or you're winding down that foundation, a donor advised fund is a great place to park that money. And then from there, you can make those annual gifts to Mercy or any other charity. You can set up then other gift planning tools with the charity. So you could set up an endowment or a scholarship or something like that and have the money move over from the donor advised fund to Mercy and then fund whatever project that you're now developing with the charity. So it can be a nice tool depending on what it is that you're doing and what you're trying to accomplish.
Okay, here's a question for anybody who wants to jump in and answer it. Can people divide their beneficiary plans between their heirs and a charity? So you would have a split, like a 10-90 split or a whatever?
Absolutely. You can do it whatever you want. So if you can think it, we can write it. And that goes towards looking at that whole plan and the things that are keeping you up at night and worrying you. And so depending on if you want to benefit that charity and your family, that it may make sense to have that beneficiary designation have different percentages for the charity and the family. Or it may make sense to just do the family in the will with, your plain vanilla assets, your bank accounts, brokerage accounts, those kinds of things, and then do the money to the charity from your beneficiary designation on your retirement account. And that's why that team approach we were talking about before, and going to talk to the attorneys and the accountants and the financial advisors can help you figure out the best way to accomplish all the objectives instead of just one targeted objective.
And I just want to clarify for everybody too, this is something that I've actually been through. When Chris talks about a more efficient way, and you and Tara talked earlier about probate. The thing about probate, anything going through probate, is it takes a while, right?
So it depends. It depends on the jurisdiction you're in. It also depends on sort of what's happening. Courts we find are very cyclical. So sometimes they move quickly, sometimes they move slowly. and there's no way of predicting it. Certainly the pandemic has wreaked havoc on the court system, but I will say that even during the pandemic, some counties are still moving very rapidly and others are just like having a nightmare trying to do anything. It also depends on where you live. So we hear some states, I heard from someone that Rhode Island takes a year to probate. New York, certainly, it's a couple of weeks to a couple of months, depending on what's going on. So it really depends on what's happening.
Okay.
And having those conversations with your advisors is important to figure out what makes sense for you.
To the Mercy alumni in secondary ed who left us a message. She teaches at Ardsley Middle School. She's going back into the classroom. Yes, this slide presentation will be available via email. So I don't know if Lauren, I don't know if we missed you or not, but I just wanted to let you know that. Okay, let's change gears again and get to the CARES Act, the 2020 CARES Act, and how that impacts you. Tara, you mentioned it, and now this is our time when we're going to come back to it. And whoa, look at all that writing on that slide. Okay, take it away.
So in March 27, 2020, there was, the act, and then they updated it. So that I'm going to talk about the updated part, right?
Right.
And you can actually get all this information on the slide deck when it gets sent to you. But I'm just going to give you an example, which is what I talked about earlier. So the itemized and versus non-itemized. So for example, if you are someone that is, again, doesn't have a lot of deductions, which I think a lot of people in this call probably do, but maybe you have people that you know of that just have a standard deduction. That means that you don't have many deductions, you don't have a lot of charitable giving, et cetera, et cetera. So if you know of anybody or in your family that might be younger, that doesn't really have the itemized deductions yet, then for a standard deduction, if they make a contribution for $300, they'd be allowed to deduct that. Previously, there was a limit for a single filer and a married couple, that the limit was $300 of a limit. Now they're doing $300 for single and $600 for joint. So for the example, if you are an itemized person, which means that you've got, mortgage interest or property taxes or medical expenses, they're usually all calculated in a certain way, and then there's limits. So in this example here, I'm saying to you, if after you're done with all of your calculations on your tax return, you get down to an adjusted gross income of, let's say, $500,000. Previously, when you did any contributions, it would have been limited to 60% of that. I'm doing real $300,000. So if you made contributions of $400,000, you would not be able to deduct the extra $100,000. You can only deduct the $300,000. But now they're saying up to the $500,000. So if you have adjusted gross income of $500,000 and you made contributions of $500,000, all of that would be able to be put on your tax return for your calculation for your deduction. So that's something that's great. That's going to be through 2021. Now, I don't know what's going to happen in the following years, but putting a deduction of the full amount, being able to deduct the whole amount, really helps you save on your taxes. Going forward, it might revert back to the 60, or it might revert back to what was prior to that, which is 20%. Prior to the 60%, it was 20. And then there was different levels, 20, 30, 50, 60, depending on your income. So the other thing that's good is that they've added that if you have a corporation, that you can also deduct up to 25% of your taxable income. So many people, they have on their tax return, they've got maybe an S corp, or they've got a corporation where they're giving comes back into their personal return, or you have a corporate company which has a corporate return. So that's something that you can think about, where you can do charitable giving from your corporation as well, and that it's limited to 25% of your taxable income. So the other part where I was talking to you about earlier was about your required minimum distribution. So you can continue to make contributions from your IRA to a charitable organization. And so down below at the bottom, it talks about the required minimum distribution of 72. So once you reach a certain age, 72 and a half is usually the age, you are required to take out of your account a certain amount of money, depending on a calculation. So what this rule is letting you do is that you can take that required minimum distribution out and send it directly as a contribution to some organization. And if you do that, it would be also, it would be meeting your required minimum distribution. And also you'd be getting a tax deduction included in your adjusted gross income limit of $500,000. So it's something to think about if you are, you've got your required minimum distribution that you want to take out, but you're not really sure if you really need it. And like for 2020, people didn't take it out. So in 2021, up until December, take that money out and put it to a charitable contribution, and they can also get a deduction for it.
Can I ask you a quick question?
Mhm.
When you say you don't know if this will last beyond 2020, 2021, and maybe it'll be more, maybe it'll last, is this politics that may affect these things?
I don't like to talk about politics, but this all happened from the CARES Act, and we all know how difficult it was, and the fighting across the lines, and trying to get some kind of relief for some people.
Right.
So, it all depends on this. This happened with one president, and now there's another president, and this, the work that the work that everybody does down in Washington and across the country that are doing their best to help the country and on both sides.
Right. It was less, getting political than how you think about this as
Probably
a temporary thing, or,
I mean, probably because of the fact that, the IRS is receiving less money because we're getting more deductions. They're going to look across the board to see, what's the revenue that the IRS is generating from our tax returns. They'll look at the trend, they'll look at the history, they'll look at what's going on. Taxes are also, when we think about taxes are also for the economies of the world as well. It's also, how do we help the economies of the world? How do we help communities of the world, right? So being able to put contributions together and having that tax deduction speaks to that, right? The taxes are for helping the social climate, right? Our taxes go to social climate, right? What we need to do for parks and recreation, and all the different organizations that are run by the federal, state, and city governments, right? That's what the taxes help to support, right? So if I don't really know what they're going to do. There doesn't seem to be any indication from what I'm seeing that there's going to be any keeping it past 2021, but I don't really know. But going back to 60% could be an option as well. I don't really know, unfortunately.
Okay. I'm looking to see if anyone has questions about the CARES Act. And of course, we're going to give you everyone's contact information here at the end, so that if you do think of questions afterwards, you can come back to these people. So planning considerations, is this your slide too?
Yes, it's just kind of repeating what I said. And we really only need one slide. But so when you're thinking about preparing your 2020 income tax return, make sure you're looking at your standard deduction and your itemized deduction. And if you've got a standard deduction because you haven't met the limit, if you've done your contributions, because sometimes people make contributions and they don't really think about it because, it's just $200. It's just $100. I'm not going to keep track of that. But if you did do a contribution, you have to, number one, make sure that you always keep track of your contributions. You want to keep track of the letter that you received from the organization. You want to keep track of the date. You want to show proof. If you ever get audited for any of your contributions, you always have to make sure that you keep track of the paperwork. The paperwork should be attached to your tax return. It doesn't need to be sent in with your tax return. Don't send it in with your tax return. But when you do your tax return, in your paperwork that you have in your file, make sure you keep track of the proof from the organization that you received, that they received the donation from you, and make sure that you keep track of the proof of the payment. And the other thing to think about too is when you do, the standard person, right? That does the 300 or the 200. A lot of the times, let's say the contribution is for $300, you get a letter for $300, but you got a benefit from that. Maybe it was from a dinner. And actually it'll say that, out of the $300, $200 went to the dinner. Well, that $200 doesn't contribute it's not a contribution. You don't include that $200 on your tax return. You only include the $100 because that's the actual contribution that's going to the organization for the work that they do.
Right, right.
So that's for the standard people, right? For the itemized people, again, just making sure that you think about what is your adjusted gross income, and you can meet that adjusted gross income 100% for whatever your, and this will be the best year to combine your gift with the conversion from a regular IRA to Roth IRA. And if you have, like, again, the required minimum distribution, if you, think about the fact that you need to do your required minimum distribution, think about maybe doing a contribution straight from your IRA, so that you can take a deduction for it as well.
Okay. I want to get back to the motivation man in this talk, and that's Elliot. Sweetser, do you, let me just bring you in and ask you, is there any of this that you'd like to comment on, or any new thoughts from you?
Well, I think that the fact that Mercy College has put this together is a very valuable public service. I think that it'd be congratulated on their forward thinking. As a donor, it makes me feel good that this sort of thing is being undertaken.
And, so I have a question, Elliot. I don't know, Elliot, whether you have a perspective on this or not. Much has been said about the boomer generation and what they did. And now it's the millennial generation, which will sort of come into their own in terms of making money and being in a position to make very forward-thinking decisions about all of this. If you were talking to millennials right now, what would you say to them?
I tend to have a broad stroke approach, and I think this is true for elderly people and for folks just starting out in their careers. I strongly believe that people should have a comprehensive financial plan that takes into consideration investments, insurance, liability, the whole gamut. And I don't think that changes much from generation to generation, even though the content of the plan would be would differ.
Much has been made of the fact, though, that they might not be able to save as much and then give as much.
I've read comments like that, and I've also met some very bright young people who blow me away in terms of their capacity to change the world. So I'm very, very optimistic that the younger generation will do just fine.
Okay, anybody else want to take get the younger generation, by the way, to pay attention here?
So one of the things that I like to tell my younger clients is that it's very important to have a comprehensive estate plan in place, because, and certainly the pandemic has shown a light on this, we just never know what's going to happen and when. So you want to make sure your family's taken care of and all of your objectives are covered. And a lot of that is philanthropic, and that it's important to spread the message to all generations, including the younger generation. Again, it's not about the size of the gift necessarily. And I raise philanthropic giving with all of my clients, and and some of them are very surprised. Why are you talking to me about this? I don't have millions of dollars. I said, but don't you give, $10 to a charity, your favorite cause every year? Don't you write those small checks? And a lot of them do. And they don't realize that that is planned giving, that is that's philanthropy, and that it doesn't have to just be the big bucks. And it's an important message to be giving every year. A lot of charities receive grants based on the number of people that give to them. So if everybody gave $1, if all the alumni of Mercy, if every single one of them gave $1, then that might expose Mercy to a lot of other grants that they could get, because they would see the commitment of the alumni in giving. So while of course we want to encourage them to give capacity gifts change over time. And so what's capacity for my, 30-year-old that comes in that just had a baby, and capacity for the 65-year-old retiree might be very different, but it still is a capacity gift, and it's something to be proud of, and it's something to encourage, and it's something to explore and let them know it's out there. and that there's lots of different ways to do it. I always describe estate planning as a buffet, that you go up to the buffet and you do that lap around it and you see what makes sense for you at that point in time. And all of us, we go up to the buffet. One day we pick one thing, the next day we pick something else. And the same for estate planning and charitable planning, is that it's not a one size fits all. It's what's right for me today. And that will change over time, and keeping these conversations going and flowing is so important, and connecting them with their charities and how to get involved also with their time, rolling up their sleeves, getting involved. That often will lead to increased dollars down the road, but it's a great way to give and support the institutions when maybe you don't have as many dollars to give.
And I mean, Elliot, you've said it to us several times. It's important to leave a legacy, right?
Yep.
It's just important to do that.
And just to comment about the younger generation, I've been astounded over the years to recognize the lack of financial planning, I guess.
Awareness, maybe?
Yeah, exactly. I think the younger generation is much better prepared to make better decisions about the composition of their insurance, their investments, and so on, than previous generations. Financial literacy is the term I was looking for. I think the schools like Mercy are doing a good job in that regard. So just increasing the knowledge about the financial issues that perhaps other generations did not have the advantage of.
Right. It's absolutely true. And our Career and Professional Development Office is in the process right now of adding some very critical financial literacy content to the work that it does with our students. So I will echo that. All right. We only have about 3 minutes, and I want to, first of all, see if any of you have any final thoughts. And I want to give anyone who's watching a chance to put something in the chat room. Anything you didn't get to say, Leslie, Chris, Tara, Elliot, that you would like to say?
I'd like to follow on to what Elliot's saying there. When I think about, and I've been a consultant for big four firms for years, and I've been an adjunct since 2009. And every time I have a class, when I'm doing my accounting, I always kind of start off the beginning with the calculation for time value of money. I always ask people about, have you, any of you ever, if any of you are working, do you actually have a 401k or some kind of retirement that is offered to you? And there's always, probably 80% of the class raises their hand. And then I say, how many of you actually contribute to it? And it used to be none did, but over the last 3 or 4 years, I've seen now it's like almost more than half of the class. Yeah, definitely. I'm definitely contributing to that. So I've definitely seen a difference in when I use examples from the real world in my accounting or my tax classes for savings. I always think about the students wanting to save or thinking about their future. Like, when I'm thinking about, the long-term bonds or whatever it is, or long-term investments or long-term notes, I'm talking about a mortgage. Do you have enough money to put down for a mortgage? And how do you think about that? And I use those types of examples. And I think today students are more aware of it than they were in the past. And it might also be because of the fact that more people, when I was growing up, my parents, my mother and father were, they didn't go to college. And I think a lot more people going to college or having education are going into the newer generation, that they're getting that information from their parents. That's what I've been seeing from the students anyway.
All right, fascinating. Okay, Elliot Sweetser, Christian Templeman, Leslie Levin, and Tara, of course, Tara Foley. Thank you all very much. We're going to put this up for people who can, because this was a lot to digest, a lot. And so we want to put your contact information up there for people to, and it will be in the PowerPoint slide that we share with everyone. If you have any other questions you want to follow up on, you can, contact any of these people directly. And we also want to show you a slide with our major gift officers, Katie Coppinger and Mike Zerilli and Patricia Burns. They are also people you could contact. And I saw that we got a big thumbs up from Katie on the If Every Mercy alumni would donate $1. So I just want to come back to that because that would be wonderful. And let's see if I have any other slides that I want to show you. No, I think that's it. And it's 12:01. And I want to thank you all very, very much for attending this. And I hope you were able to take in all of this information. And if not, you'll get a chance to absorb it again. And everybody, have a great day.
Thank you.
Thanks. Bye-bye, everyone.